welcome to the deep dive.
Yeah, glad to be here.
If you're tuning in, you're probably looking for a serious shortcut, maybe some clarity on Ethereum.
Definitely one of the most exciting assets out there, but also, let's be honest, incredibly chaotic right now.
Absolutely. The price predictions for 2025, they're, well, staggering. We're talking 5 figures.
Huge numbers being thrown around.
But then you look at the actual trading floor, like right now,
Yeah.
and it just feels like panic.
And that clash, that dichotomy, that's exactly what we're going to unpack today.
Well,
We've got this really intense structural optimism, driven by fundamental changes in Ethereum itself.
Deflation, institutional buying.
Exactly. Deflationary economics, massive institutional accumulation, but it's running headfirst into genuine short-term skepticism.
Yeah, real-time market weakness and these capital flows that just seem to contradict each other day by day.
It's really a battle, isn't it, between the long-term vision and the daily tactical noise.
So our mission here is to try and synthesize all of this for you.
Make sense of the contradiction.
We've pulled together sources from, well, all over. High-stakes prediction markets.
Those ETF flows, which are just wild.
Super contradictory data there. Plus, the big bank price targets Standard Chartered, Goldman.
And then we'll get into some really cutting-edge stuff.
Yeah, this is academic research using large language models, AI, to try and forecast all this volatility. It's fascinating.
So the core question, the paradox we need you to keep in mind is this. How can Ethereum have this fundamental setup pointing towards, say, $10,000 or more?
Right.
While at the same time, we're seeing huge short bets being placed right now and these big institutional outflows happening.
It doesn't quite add up on the surface.
Let's start with the immediate chaos then, the pulse of the market this week.
Okay, yeah, let's ground this.
Yeah.
There was a really specific event, super tangible, highlighting the current risk appetite. We're talking prediction markets, Kelshi specifically.
Ah, yes, that big trade.
Exactly. One single trader put down almost $30,000, $29,588 to be precise,
Which is a lot for that kind of platform.
into contracts, betting against Ethereum, reaching $4,490 or higher by October 3rd, 2025.
Wow, that's a bold short-term negative bet. Almost sounds personal.
It is significant. And what's interesting is the context when they made that bet, the market itself was pricing in like a 61% chance that the bet against ETH would actually pay off.
So the market sentiment, at least in that specific contract, leaned bearish in the very short term.
Yeah, it tells you that despite all the long-term hype you hear, there's real capitalized skepticism about any immediate aggressive price jump.
People putting serious money behind that skepticism.
And it's important for you to know how these things resolve. It's not just some random price flash.
No, it's quite rigorous.
It uses the Ethereum Real-Time Index, the ERTI. They average 60 seconds of data right before the deadline.
So it's designed to be a pretty credible snapshot of the actual market value at that specific moment. Less room for manipulation.
Okay, so that's one snapshot of the mood. Now let's look at the money flows, because this is where you really get whiplash.
Yeah, the ETF data has been, well, confusing is putting it mildly.
In the last week of September 2025, spot ETH ETFs saw massive outflows. We're talking $795.6 million leaving.
That was the worst week they'd had since launch. A huge red flag, seemingly.
And the total for the month by September 29th was outflows of nearly $400 million.
Okay, so picture this. Nearly $800 million out in 1 week. You'd think, okay, institutions are bailing.
That's the obvious narrative, right? Big money's getting cold feet. But then
Almost immediately, just days later, around October 1st.
it completely flipped.
Completely flipped. Those same ETFs recorded positive inflows for 2 days straight, totaling $674 million coming back in.
Whoa. Okay, so that's not an exit. That's something else.
It's aggressive tactical movement. It signals that institutional demand didn't just vanish. Maybe it just repriced or repositioned. It's definitely not a unified institutional view.
So we're not seeing institutions running for the hills. It's more like aggressive trading, using the volatility.
Exactly. High-frequency thinking, perhaps. Strategic plays rather than long-term abandonment. They're playing the swings.
And how does that compare to, say, retail sentiment?
Well, that's another contrast. Despite all this institutional back and forth and the volatility, a recent poll showed 46% of retail traders still expect ETH to hit $5,000 by the end of this year, 2025.
So retail seems a bit more steadfast, looking past the immediate noise.
It seems that way. Maybe holding on to that longer-term vision we talked about.
Okay, so if the short-term picture is, frankly, a mess, Let's zoom out. Let's look at why anyone is still fundamentally bullish.
Right, the why.
This gets into the structural mechanics, the things underpinning those huge five-figure predictions. Ethereum's unique economics.
This really is the bedrock of the long-term optimism. It starts with the merge, the shift to proof of stake.
Fundamentally changed everything.
It fundamentally altered the supply dynamics. Annual new ETH issuance just plummeted from around 4.9 million ETH per year,
Which was already factored in.
down to roughly 972,000 ETH. That reduction alone is a massive supply shock compared to the old system. And of course, the energy reduction was huge too, over 99.9%.
But the supply doesn't just slow down, it actually shrinks, right? Because of the burn.
Exactly. That's the other key mechanism. EIP 1559. It mandates that a part of every transaction fee gets permanently destroyed, removed from circulation forever.
And that adds up.
Oh, it adds up significantly. Since EIP 1559 went live, over 1.99 million ETH has been burned. Poof, gone.
Wow.
That works out to about a 1.32% annualized burn rate currently. So issuance is down and supply is actively being destroyed.
And that deflationary pressure gets amplified by, well, where the existing ETH is going, right?
Yeah.
Staking in ETFs.
Precisely. This is the supply squeeze effect. Two massive pools of ETH are being taken out of active circulation.
Tell us about the scale here. It's pretty immense.
It really is. Right now, you have about 35 million ETH locked up in staking contracts. It's huge. It's 29% of the entire supply, just sitting there, securing the network, not readily available to be sold.
29%, okay.
Then, on top of that, you have the Ethereum ETFs. By the third quarter of 2025, they had accumulated 6.42 million ETH. That's about $27.6 billion worth.
So staking locks up supply, ETFs lock up supply.
And the combined effect is dramatic. The amount of ETH actually sitting on exchanges available for immediate trading, it's down to a 9-year low.
9 years. So way less liquid supply available.
Exactly. Basic economics, less supply available to trade, potentially growing demand, especially from institutions via ETFs. That's the classic recipe for potential long-term price increases.
Okay, that makes sense structurally. But we also need to talk about utility. The network keeps upgrading, right? And sometimes those upgrades have, well, interesting side effects on the deflation story, like Denkun.
That's a really important nuance to understand. Yes, upgrades improve the network, but they can affect the metrics we just discussed. EIP 4844, the Denkun upgrade, was fantastic for users.
Made layer 2s cheap.
Exactly. Slashed layer 2 transaction costs by something like 90%. That fueled enormous growth in DeFi and other applications on top of Ethereum.
But less cost means fewer fees being burned on layer 1.
Precisely. Because so much activity moved to these super cheap layer 2s, fewer high-fee transactions were happening directly on the main Ethereum chain. This caused the ETH burn rate to temporarily dip in the first quarter of 2025.
So it looked like deflation was slowing down.
For a moment, yeah. But it's not a failure of the system. It's actually a sign of it working as intended. L2s handled the bulk, the cheap stuff, keeping the main chain from getting congested.
While layer 1 remains the core settlement layer, the security hub.
Exactly. Total network activity across L1 and L2 remains incredibly robust. The value is still being secured by Ethereum.
And this push for utility, for scalability, it's not stopping. The sources mentioned the Fusaka upgrade.
Right. That's tentatively slated for November 2025. A key feature there is PeerDes.
Which does what?
It's designed to increase the data capacity for layer 2s, what they call data blobs, by a factor of 8. 8 times more space for L2s to post their data cheaply.
Wow, another huge scalability boost coming soon.
So the network keeps evolving, keeps getting more useful, and that continuous improvement underpins the idea that Ethereum isn't just, digital gold. It's a platform, a utility.
Which brings us back to those price targets. If the structure is deflationary and the utility keeps growing,
then you start to understand why major financial institutions are putting out these, frankly, staggering price projections for 2025 and beyond.
Okay, let's dive into those. Because when you see the names and the numbers, the short-term volatility we discussed almost seems beside the point.
It certainly puts it in perspective. And these aren't just random crypto enthusiasts. These are major banks. Standard Chartered, for instance.
What are they saying?
Their forecast is $14,000 plus by the end of 2025.
$14,000 for ETH.
Their reasoning, pretty straightforward.
Wow.
The impact of the spot ETFs getting approved and continuing network upgrades, improving utility.
Okay, $14K is already huge.
But they actually went even further than that.
Wait, further? How much further? That sounds almost like fantasy territory. What possible rationale leads higher than $14K?
Well, it's based on a relative valuation argument, specifically against Bitcoin.
The ET-BTC ratio thinking.
Kind of. They suggested ETH could potentially hit $35,000 if Bitcoin were to reach $175,000.
Okay, so that's a big if. It's a conditional target tied to a massive boom in the whole crypto market cap.
Exactly. It's a scenario based on the idea that if crypto goes parabolic, Ethereum, due to its utility and DeFi dominance, would capture a very significant share of that value inflow.
Right, so maybe treat the 35K number as an extreme bull case scenario. What about other, perhaps more grounded projections?
Well, Deltec Bank is also very optimistic. They're looking at $10,000 by the end of 2025.
Okay, 10 GAW seems to be a recurring number.
It does, and Deltec sees it rising further to $22,500 by 2030. Their rationale points back to the fundamentals, the POS transition, the London hard fork with EIP 1559.
And it's not just traditional banks, right? What about well-known traders?
Yeah, the sources mention GCR, a pretty renowned crypto trader, famous for calling the El Lune collapse correctly.
Okay, so they have some credibility.
GCR also predicted $10,000 for ETH in 2025. Their reasoning focuses on Ethereum's central role in DeFi and also broader macroeconomic factors, tailwinds maybe.
So banks, traders. What about analysts generally?
Finder polled about 50 industry experts. If you average out all their predictions, you still land at a pretty bullish $6,105 by 2025.
Still significantly higher than current prices.
And their reasoning echoes the others. Institutional investment flowing in via ETFs, plus ongoing tech advancements.
And then there's Goldman Sachs. Their view seemed even longer term, almost philosophical.
Yeah, Goldman wasn't putting a specific 2025 number on it in these sources, but they made a bigger prediction that ETH would eventually overtake Bitcoin as the preferred store of value.
Overtake Bitcoin because of its utility.
Precisely, because you can do more with ETH, especially in DeFi. Now, for ETH's price per coin to actually exceed Bitcoin's, it would need to go past something like $96,500, which is obviously way out there.
But the core idea is powerful. Utility might eventually win out over pure digital scarcity.
That's the thesis. And even just looking at the charts, technical analysts were seeing bullish signs too. The weekly chart apparently showed a bull flag pattern forming.
Which is a continuation pattern, right? Suggesting the uptrend could resume.
Exactly. And the technical target derived from that specific pattern was $10,533.
10,000 again. Okay, so there's a convergence of factors all pointing towards significant upside despite the current shock.
A strong convergence, yes. From fundamentals to institutional analysis to technicals.
All right, let's shift gears completely now. This next part is where things get really, really interesting, I think. Moving beyond traditional analysis.
Into the realm of AI.
Into how cutting-edge AI research is trying to get a handle on forecasting these incredibly volatile prices. We're talking large language models.
Yes, this is genuinely novel stuff. Researchers are taking pre-trained LLMs, models like Llama-3, Llama-2, even older ones like GPT-2.
Models built for understanding and generating text.
Exactly, and they're adapting them to directly process financial time series data. Specifically, the daily open price for ETH in this study.
So wait, not using them to analyze news sentiment or tweets about ETH?
No, this is different. This is feeding the raw price data, the numbers themselves, directly into the LLM architecture for forecasting.
But how does that even work? LLMs understand language, grammar, context. How do you get them to understand price charts?
It's a clever approach. They use a framework called the Frozen Pre-trained Transformer, or FPT.
Okay.
Think of the core layers of the LLM, the parts that have learned all that general knowledge about patterns and sequences from reading the internet. Those parts are kept frozen. They don't retrain them.
So the core intelligence remains intact.
Right. But they do fine-tune the very first input layers and the normalization layers. Essentially, they teach the model how to read the time series data format and feed it into that powerful pre-existing analytical engine.
So you're leveraging the LLM's general pattern recognition ability, but applying it to prices instead of words.
That's the idea. You're using its deep understanding of sequences and context, which turns out to be highly effective for financial data too.
And did it work? When they tested it, say, Llama-3 against traditional financial forecasting models like LSTMs or ANNs.
It worked surprisingly well, particularly Llama-3. In short-term forecasting tests using 7 days of price data to predict the next day, Llama-3 achieved the lowest error rates.
Lower than models specifically designed for time series.
Lower mean squared error, lower root mean squared error on the dataset they used. It showed, and this is the key part, superior performance.
Wow. What does that imply?
It implies these large models, because of their vast pre-training, are exceptionally good at handling data that is noisy, maybe sparse, and highly volatile.
Which perfectly describes crypto markets.
Exactly. They also excelled in what's called few-shot forecasting,
Rian.
meaning they can make reliable predictions even with very minimal input data. Again, that highlights their potential in rapidly changing, unpredictable environments where you might not have a long, stable history to draw on.
So the takeaway here is that these incredibly advanced AI models, originally built for language, might actually be better at seeing subtle patterns in chaotic price action than older, more specialized financial models.
It certainly looks that way from this research. Their generalized knowledge base seems to give them an edge in making sense of complex, noisy systems.
Okay, that is fascinating. So let's try and bring this all together. After diving into the prediction bets, the ETF whiplash, the structural case, the huge bank targets, and now this AI forecasting, what does this all mean for you, the listener, trying to understand Ethereum's path?
I think it means you have to accept the two realities coexist. There is undeniable short-term trading volatility.
We see it in the ETF flows and those big prediction market bets like the 29K short.
Absolutely. That tactical high-frequency trading is real. Capital is flowing in and out rapidly. But that volatility is happening against a backdrop of powerful long-term structural forces,
The deflationary pressure from the burn and staking.
which is removing supply from the market consistently. And the undeniable fact of institutional accumulation, mainly through those new ETF products. Big players are building positions.
So those structural factors are what give analysts the confidence for those multi-year targets,
Yeah.
the $10,000 plus figures.
That's the justification. They believe those fundamentals, the shrinking available supply, the growing utility, the institutional access will ultimately outweigh the short-term noise.
It feels like the market itself is evolving, becoming more sophisticated.
I think that's right. Whether you look at the banks trying to model utility value or this cutting-edge research using LLMs for price prediction,
It's moving beyond simple speculation.
it seems to be shifting towards much more complex financial modeling and technical analysis, trying to really understand the underlying drivers rather than just chasing momentum.
Okay, so a final thought then, something for you, the listener, to consider as you process all this.
Go for it.
Well, we mentioned that upcoming Fusaka upgrade, tentatively November 2025.
Right, with PeerZest, the 8x increase in data blob capacity for layer 2s.
Okay, so layer 2s are about to generate vastly more data, reflecting network activity much more granularly.
A huge amount more data, yeah.
Now, think about that AI research. We just heard how well LLMs like Llama-3 performed at forecasting, even with current data.
Their strength was handling complex, noisy data.
So here's the provocative thought. Given how good these LLMs already are, how much more accurate could their predictions become once they can ingest and analyze that massive increase in real-time Layer 2 network activity data from Fusaka?
That's a really interesting point. More data, especially data reflecting actual economic usage on L2s, feeding that into models already proving adept.
Could that be the next frontier in crypto forecasting? Using AI to understand network fundamentals at a scale we haven't seen before.
That is definitely something worth watching. A fascinating question for the future of analyzing Ethereum and maybe crypto as a whole.